Welcome. Today, we're pulling back the curtain on the new Wall Street. This isn't your grandfather's stock market. It's a world run by data and algorithms, not just gut feelings. We're going to break down exactly what quantitative trading is, how it works, and make this whole kind of complicated subject feel a lot simpler. So let's get right into it. You know, this quote attributed to Einstein really hits the nail on the head for what we're talking about today. It's so easy to think that to win in the markets with computers, you need these insanely complex PhD level models. But, and this is the big secret, it's often the exact opposite. As you're about to see, the strategies that actually work, they're often built on a foundation of, well, elegant simplicity. All right, here's our game plan. First up, what is this new Wall Street? Then, we'll hunt for profitable ideas and the traps to avoid. After that, we'll look at a cool AI case study in crypto, then see if it survives the all-important backtest. And finally, we'll talk about risk, psychology, and the future of it all. Okay, Section 1. The new Wall Street. Is it really man versus machine? Let's start with the basics. What is quantitative trading? And who are these quants you always hear about? Is this really a fight between human gut feelings and, cold calculating code? So here's the big difference. Think about traditional trading. It's all about a portfolio manager's intuition, right? A gut feeling, a reaction to the latest news headline. Quantitative trading, it's the total opposite. It's all about digging through mountains of data to find statistical edges, creating a rock-solid set of rules, and then, and this is key, letting a computer pull the trigger, completely emotion-free. Now, here's where it gets really interesting, because you might think you need a PhD in astrophysics to be a quant, and sometimes that can actually get in the way. Take the story of Ernest Chan. This guy is the real deal. PhD from Cornell, worked at Morgan Stanley, the whole 9 yards. And guess what? For years, all his super complex genius-level models, they just kept losing money. So when did things turn around for him? It was only when he ditched all that complexity and started using strategies that, honestly, a sharp high school kid could grasp. That's when he started making money. His story is just a perfect lesson that the market doesn't really care how smart you are or how complicated your model is. In fact, simpler models are often way more durable. They don't get faked out by random noise. What the market rewards is a simple, solid idea that's been tested to death and followed with discipline. That's it. Okay, Section 2, hunting for profitable ideas and the common traps. So, if simple is the way to go, where do you even start looking for these ideas? Well, before you can write a single line of code, you need a strategy. And let me tell you, that hunt is an absolute minefield. It's full of these hidden traps that can make a terrible idea look like a guaranteed win. First things first, how do we even know if a strategy is any good? The industry standard is something called the Sharpe ratio. It's not just about the raw profit. It's about the quality of that profit. It basically asks, for every unit of crazy, stomach-turning risk I took on, how much return did I get back? A high Sharpe ratio means your returns are smooth and steady. A low one means you're on a wild roller coaster. And a good rule of thumb, you're generally looking for a Sharpe of at least 1 before you even think about taking a strategy seriously. All right, let's talk about the first big trap. It's called survivorship bias. This is a sneaky one. It's what happens when the historical data you're using has conveniently forgotten about all the losers. It only shows you the companies that survived to the present day, and it totally ignores the ones that went bankrupt or got delisted. So you end up with this incredibly skewed, overly optimistic view of the past. And check out this crazy example from Chan's book. Imagine you test a strategy. Back in 1990, you buy the 10 cheapest stocks you can find. If you use a biased database, one that only has today's surviving companies, your backtest shows an incredible 388% return. You'd think you're a genius. But when you run the exact same test on a clean database that includes all those companies that went belly up, the real return was a loss of 42%. That's the difference between thinking you found gold and actually losing your shirt. That's survivorship bias. The next trap is even sneakier. It's called data snooping bias, or what machine learning folks call overfitting. I love the phrase, torturing the data until it confesses. That's exactly what this is. You just keep tweaking your model, adding more and more rules until it perfectly explains every single random up and down tick in your past data. The problem? You haven't taught it a general rule. You've just taught it to memorize the answers to an old test. It's completely useless for the future. Okay, Section 3. AI builds a buy signal, a crypto case study. So enough theory, enough warnings about what can go wrong. Let's see how this stuff actually works in practice. we're going to dive into a really cool research paper where they used AI to try and build a profitable buy signal for some major cryptocurrencies. The specific AI technique they used is called supervised learning. And honestly, it's pretty straightforward. Think of it like teaching a toddler to recognize a cat. You show them picture after picture saying cat, not a cat, cat. You're giving them labeled examples. Well, it's the same idea here. You feed the machine a ton of historical market data, and you tell it, see this setup? That was a great time to buy. This one? Nope, bad time. The AI's job is to figure out the patterns that connect the market setup to the right answer.
So here's the play-by-play of what the researchers did. Step 1, they grabbed a bunch of 15-minute price data for cryptos like Bitcoin and Ethereum from 2018 to 2021. Step 2, they calculated a bunch of standard technical indicators to act as clues for the AI. Step 3, they took 80% of that data and used it to train their model, to let it learn the patterns. And Step 4, the big test. They unleashed the trained model on the last 20% of the data, stuff it had never seen, to see if it could actually predict good buy signals.
And the results? Well, they were pretty wild. When they fed the model signals from Bollinger Bands, it got almost 90% accuracy. Pretty good. When they used the MACD indicator, it jumped up to nearly 96% accuracy. Awesome. But then they fed it signals from the RSI, the Relative Strength Index. And that's where things got crazy. 100%. On their test data, the model had perfect accuracy. And the F1 score, which is just another measure of how good the predictions were, was also a perfect 100. Now, I gotta tell you, in the world of quant finance, when you see a perfect backtest, it's both super exciting and a massive red flag. Your brain immediately starts screaming, is this real? Did it actually find the Holy Grail? Or did we just get insanely lucky on this one specific test? And that very question leads us to Section 4, surviving the backtest, the final exam. Because that perfect score, it's just the start. It's not the finish line. Now comes the single most important part of the whole process, making sure your idea isn't just a fluke. The absolute best way to think about this is like studying for a test in school. The data you use to build your model, that's your in-sample data. It's the practice exam. You've got the answer key, you can study it all you want, but the real test, the final exam, is the out-of-sample data. This is brand new information the model has never, ever seen before. And this is where you find out if your model actually learned how to solve the problems or if it just memorized the answers from the practice sheet. And look, this brings us right back to that data snooping trap we talked about. A strategy that aces the practice exam but completely bombs the final. That's the definition of overfit. It didn't learn anything real. That's why this step is so crucial. Rigorous testing on data it's never seen before is the only real weapon a quant has to stop from fooling themselves, from falling in love with an idea that's actually worthless. Okay, last section, risk, psychology, and the future, the final boss. So let's imagine you've done everything right. You found a simple idea, you dodged all the data traps, your model passed the final exam with flying colors. You're ready to go live, right? Well, now you've got to face the final boss. And it's a two-headed monster, managing your money and, even harder, managing your own brain. Look, you can have the best strategy in the world, but if you mess up your money management, it's worthless. It's a Goldilocks problem. Bet too small, you don't make any real money. Bet too big, and a string of bad luck, which will happen, could wipe you out completely. That's where mathematical ideas like the Kelly formula come into play. It's a way to calculate the just right amount to risk on any given trade, balancing your odds of winning with how much you could win or lose. It's all about taking the guesswork out of risk. But even with a perfect formula, you still have to battle, well, you. These psychological biases are like ghosts in the machine. There's representativeness bias. That's when you have one bad day and that little voice in your head says, see, the whole system is broken, change it. Then there's loss aversion, where the pain of losing a dollar feels way worse than the joy of making a dollar, so you panic and sell at the worst times. But the absolute deadliest one? It's overriding the system. It's that moment when fear or greed takes over and you think, nah, I know better than the computer this time. That's almost always a disaster. And all of this leaves us with one last really big question to chew on. We've spent all this time and energy building these incredible automated systems to take flawed human emotion out of the equation. But who builds the systems? We do, flawed humans, with all our blind spots and biases. So as the machines get more and more powerful, you have to wonder, is the biggest risk out there not the market itself anymore, but some hidden, catastrophic flaw baked right into the very models we're building to protect us from it. It's a bit of a paradox, and definitely something to think about.